Hello, everyone, and welcome. My name is Jamie Doolittle, and I'm the head of Canadian Business Banking for Bank of Montreal, Central Region East. As we gather here today, we acknowledge the land we are on has, for many millennia, been the traditional territory of Indigenous nations, and we acknowledge the long history of Indigenous peoples across Turtle Island with great respect for First Nations, Métis, and Inuit communities across Canada. We honor and recognize the First Peoples and the ongoing contributions to the vibrancy of our communities today. We're grateful for the opportunity to live and work together on this land. For everyone watching, we're excited to have you join us today as Doug Porter, our BMO's chief economist, dives into key market insights arising out of these past 18 months, a historically challenging time around the world. After spending many months in survival mode, dealing with complexities and uncertainties associated with the pandemic, restrictions have slowed, and we're very optimistic about the future. We can expect a strong recovery from pent-up demand, which will carry us through to 2022. And with vaccines well underway, it will slow the spread of COVID, limiting disruptions so businesses will have a smoother path ahead in their recovery. We're also seeing new businesses open more now than pre-pandemic trends, and there's been a major shift to digital. The pandemic has led many business owners to build online storefronts and robust e-commerce plans, which will only help them stay ahead in the future. This is all very encouraging to us and the business community. It's time to look towards the opportunities ahead as our economy reopens and regains its strength and momentum. Whether you're a local restaurant or an online business, you are the engine of our local communities and our country's economy. You're the reason it thrives. And that's why it's incredibly important for us at BMO to see you come out of this stronger than ever, with meaningful information and support you need so you can focus on what's important, growing your business. Throughout the pandemic and beyond, our team is here to work closely with you. We're here to listen and offer expert advice tailored to your business's unique needs to ensure that you're positioned for a healthy recovery and so you can make real financial progress. And that's exactly what today is about. Doug will give us a full view on what's happening in your market and how it's impacting our economy and perhaps your business. After that, we'll open up the floor for questions and answer the ones that were submitted in advance. Please submit your questions in the Ask a Question box at the bottom of your screen. And finally, as we close out Small Business Month, a time to celebrate your success and contribution to our communities, I want to thank you for trusting us with your business. So with that, I'll turn it over to Doug.
Thank you very much, Jamie, and good afternoon, everyone. It's a pleasure to join you here today, even if it is only virtually. As Jamie indicated in our opening comments, there are many, many different cross currents affecting the economy right now, and I'm going to try to deal with a lot of them. Of course, just yesterday we heard from the Bank of Canada with a pretty tough message on interest rates. We just had a survey this morning of small businesses across the country, where optimism came back a little bit in October. So there are a lot of different forces at play. I would say that when we look at it from a very big picture, probably the number one issue we're dealing with right now in the economy is actually moved beyond the pandemic. It actually is the many supply challenges that we're seeing right around the world. And of course, you can't go a day without reading about some new issue or some new shortage that we're dealing with. I actually just want to start off with a very big picture comment, and if we could just move to my first slide, just beyond the cover page. I'll let you read this while I'm making a few other remarks about the supply chain. First of all, I love the punchline here. That we're even Santa's even running out of coal. Who knew in a world where we're actually trying to move away from coal that we'd actually have a shortage of coal, which is exactly what we have in China. But that just gives you, just a sense of how widespread the supply issues that we're dealing with. But the overall comment I want to make is, supply is actually at an all-time high. The reason why we're running into supply shortages or challenges is because it's being faced with a tidal wave of spending demand. Consumers have been so well supported by low interest rates and government supports around the world, that we've just got a tidal wave of demand, and frankly, supply just can't keep up. It's growing. It actually is expanding. It just can't keep pace. with the tremendous level of demand we've seen. And I guess the way I would look at the supply challenges is that essentially they're a limiter in terms of how fast we can grow in the next 18 months. Not a hard stop limiter, but they do act as a bit of a brake in terms of how quickly we can grow. If we could go to the next chart. Of course, the other big issue that's still out there, as much as we wish it wasn't, is COVID. There actually are some good signs there, some encouraging signs. If you look at the left-hand chart, that shows the number of new infections. It's basically a 7-day average in the U.S., in Europe, and Canada, and it's on a per capita basis, so it is comparable among those three regions. And what we see in recent weeks is the number of new infections is coming down and coming down pretty aggressively here in North America. Not quite as low as it got back in the good old days of the summer, but it is coming down fast. The one thing I'm keeping my eye on, though, is actually the number of new cases is starting to tick back up in Europe, and this is the so-called Delta Plus variant that's now spreading in the UK and a few other economies. Looking ahead, our view, and if you look on the right-hand side, the vaccination rates are strong almost right around the world, certainly around the Western world. The U.S. is a little bit of a laggard. It's a bit out of step with others, but still, the vaccination rates have really been strong right across the world. Canada's not an outlier. There we're high, but we're not right at the upper end by any means. Our view is that we could face, more waves in the next 6 to 12 months. Might be a fifth, might be a sixth wave. But from an economic standpoint, each wave is now making a little bit less of an impact on the economy. It still is having an effect, but our view is we're probably not going to be faced with full lockdowns again, and we're essentially building in no huge restraints on the economy in the year ahead. Now, if we could turn to the next chart. So what does this mean for growth? Well, the title of this overall event is roaring back, and there's no question that the global economy has come back with one of the strongest years that we've seen in the post-war era after having the deepest single yearly downdraft of the post-war era in 2020. But because of those supply constraints that I spoke about at the start, and because of some of the restrictions that we're still seeing, like due to the Delta variant during the summer, the high end or the most optimistic forecast that some had for the global economy and the North American economy earlier this year weren't quite met. We've somewhat chipped away at our forecast, but I think from a very big picture view, the main point is we're almost having 6% global growth this year. We're looking at almost 5% global growth next year. A normal year for the global economy is about 3% growth. So we've had nothing close to normal. Certainly not the deep decline last year or the strong growth this year. And we probably won't be fully back to complete normal until 2024. There are some regions of the world, some sectors that are probably still going to be recovering even out into 2023. We think North America will be mostly back to normal by the end of next year, but not everywhere will be. So, we're probably still looking at above average growth for the next 2 years, not quite as strong as this year. But because of, the long tail of COVID, it just means that the recovery will take a little bit longer and be a little bit more stretched out. But we do think as I said, by 24, we're essentially looking back to something close to normal. So that's the 30,000-foot look. If we could just turn to the next chart. Let's look at what it means for North America. And much like the global economy, we've had to dial back some of our extreme optimism, we and others, from earlier this year. At one point, we thought the U.S. economy was going to grow by 7% this year. That is, simply nothing I've ever seen in my career, nothing close to 7%. A normal year in North America nowadays is growth of about 2% after you adjust for inflation. So 7% would have been just incredibly strong. We've had to curve that a little bit. We're now looking at something closer to 5.5% in the U.S. That's still one of the strongest years for the U.S. economy in decades. Canada's a similar story. At one point this year, we thought the economy could grow by about 6%. Now we're closer to 5. That's about in line with consensus. The Bank of Canada actually just unveiled their latest forecast yesterday. They're looking at just a little bit more than 5% growth this year. So we're certainly not outliers at all with that call of 5% growth. But we've still got some catching up to do because last year, the economy contracted by more than 5% in Canada. If you look at the line chart there, it really does tell the picture well. That's not growth, that's the level of activity. You can see that Canada dipped a lot more than the US during the shutdowns last year, and that's because our shutdowns were more complete and longer lasting than the US. We more or less recovered in the early stages in line with the US, but then you can see we had a stutter step through the spring because of the third wave restrictions, and we actually saw a small retreat in the economy in the second quarter, whereas the U.S. kept on chugging along. So we've got more catch up to do. We've got to catch up to the U.S. over the next 18 months, and that's one of the reasons why we have stronger growth in Canada than the U.S. When we look out into 2022. Even out in 2023, I think the odds are that Canada will see somewhat stronger growth than the U.S. as we're still playing a little bit of catch up. But to me, the big picture story here is we had this devastating decline in the spring of 2020 in both economies. For my money, we've had a miraculous recovery. We were certainly on the optimistic end of the spectrum. If we went back a year or so, we thought it would look more or less V-shaped for most sectors of the economy, with the exception of, high contact sectors like travel and entertainment. And that's largely the way it's played out. I guess if we've been surprised or disappointed, it's that, the travel and entertainment industry have had to really stay under wraps for even longer than we suspected, and we don't really see a full recovery for those sectors probably until the middle part of 2022. If we could turn to the next chart, please. Now, if we break it down on a regional basis, I think the main story here is, even though every province had a slightly different experience with COVID, every province has got a different industrial structure. Every province saw a deep downturn last year, and every province has seen a nice recovery in 21. What differentiated, who was at the back of the pack, who was at the top, was essentially, how negative was your province's experience with COVID, and did you produce oil? Provinces that produced oil or had a tough go of it last year saw the deepest decline, and that would include places like Alberta, Quebec, Newfoundland, and Saskatchewan, whereas those that were let off a little bit lighter were the Maritimes and BC. And then this year it's not exactly the mirror image, but it's pretty close. Who's at the top of the board? Alberta and Quebec. Who's seen the most modest growth? The Maritimes, because they didn't suffer as nearly a deep a downturn last year in 2020. Looking out in 2022, I think we're closer to underlying fundamental growth for most economies, still a little bit above average, but essentially we're sorted out more in line, I believe, with underlying fundamental growth. And essentially we see Ontario and BC as having the best long-term growth potential among economies, and the Maritimes and Atlantic Canada and Saskatchewan having somewhat more modest growth potential longer term. Just as an aside, by the way, which province fared the best throughout this whole episode, and it's not obvious just from looking at this chart, but if you added up the 3 years, I'd have to say British Columbia probably did the best. It's partly because they had a bit of a lighter hit from COVID than others, partly because they didn't produce oil, and partly because they have the best long-term growth dynamics, we think, of all provinces. The one province, by the way, that I would circle as clearly having upside potential to what our forecast is Alberta. Given we're looking at $80 oil today and $5 natural gas, I do think if there's going to be a big surprise in the next year, it could be that Alberta does better than expected. If we could turn to the next chart, please. Now, one area where I've really been impressed at how quickly things have turned around, especially here in Canada, is in the job market. We've gone from a situation of incredible weakness in the spring of 2020 to actually, in many places, looking at labor shortages. Now, the unemployment rate is not all the way back to pre-pandemic levels, but we're getting close. And the number of jobs out there is actually exactly in line with where it was before the pandemic began. Now, of course, the population has grown since then. A lot of people have graduated, so the labor force is now larger than it was before the pandemic, and that's why the unemployment rate is higher than it was before the pandemic began. But it's interesting, even though Canada and the U.S. have had very, very different experiences throughout this, it's interesting that almost to the decimal point, we're looking at the same net deterioration or rise in our unemployment rate since the pandemic began. Both of us are up by about 1.25% in terms of the jobless rate. We do think there's going to be further improvement here. We think there's actually just an incredible amount of demand for labor. That's especially the case in the US. And so we do see those unemployment rates pretty steadily marching down over the next year. We think that by about the middle part of next year, the unemployment rate in both Canada and the US will be close to its pre-pandemic level. Now, if we could turn to the next chart, please. So just as employment has recovered, so has disposable income. But I have to tell you, one of the really interesting features or defining features of this cycle has been how well disposable incomes held up during a very tough go of it. And there's no mystery what's going on here. It's because of the heavy duty government support we saw in both Canada and the US. They took different forms in Canada and the US. The US loved their stimulus checks. We didn't have stimulus checks. We did it more through the CERB or the CRB and through Qs. But in both countries, household incomes were really, really well supported. And this happened at a time when people were constrained in terms of what they could buy. You could buy goods, but you had a hard time buying services. Even today, it's not an easy thing to go out for a restaurant meal. It's not an easy thing, certainly not an easy thing to travel at this point. So while service spending is coming back, it's still well below pre-pandemic levels. So households are still constrained in terms of what they can spend. So we've got these two conflicting forces where incomes have actually grown better than they normally grew because of government support, and yet spending has been more constrained than usual. And as a result of that, we had this explosion in household savings in the last 18 months, and it hasn't ended. Even as we speak today, if you look at that chart on the left-hand side, Canada's savings rate, the blue line, it's actually way above where the savings rate was before the pandemic began. We're still actually adding to our so-called level of excess savings in this country. We estimate that there are about $270 billion savings above and beyond where they would normally be. That's about 10% of our economy. Will all this money be spent? No, it probably won't. It's definitely that the savings has even been higher at the upper income level, but we do think a lot of that savings will ultimately be spent. Not all of it by any means, but we do think that Canadians are itching to spend again, especially on travel. One of my one of my favorite phrases is revenge travel. I think we're going to see revenge travel in 22 and 23, and I don't think people are going to be all that price sensitive. I think they're just going to want to get back out there again. We're starting to see it in dribs and drabs now in the data, but I think it's really just the opening shots, and we're likely to see just a wave of demand for travel and entertainment and that sort of thing as things slowly but surely get back to normal over the next year and a half. Arguably in the US, we're a long way down that road. They've built up a lot of excess savings, but their current savings rate is actually very close to where it was before the pandemic began. You're probably well aware that the Americans opened up a lot earlier than we did, a lot more aggressively, and in many senses, they've actually gotten much closer to normal than we are, and as a result of that, their services spending is actually a lot closer to normal than what we're seeing here in Canada. Now, if we turn to our next chart, this brings me to definitely one of the bigger issues out there right now for the economy. I started off by saying there's a lot of cross currents hitting us right now. There's a lot of things we haven't seen in quite some time, and certainly one of the bigger issues that we have not really had to deal with in quite some time is we do have some very real inflation pressure on our hands right now, and the Bank of Canada all but acknowledged that yesterday. One of the big buzzwords out there is transitory. That's a central bank word. Well, it's interesting how their definition of transitory has become a lot more elastic. I joked early on that earthquakes are transitory too, but they can still do a lot of damage. Well, now I've tended to liken transitory more to dinosaurs. Dinosaurs were transitory too, but they hung around a long time before they disappeared, and they also could do a lot of damage in their time. So I think really in terms of whether you believe inflation is transitory or not, comes down a lot to what your definition of transitory is. Our view is that, yes, some of these really extreme readings we're getting on inflation right now in both Canada and the US will eventually fade, but in the next couple months, they're probably going a bit higher yet. We think we're going to have some numbers in the US that could get as high as 6% for a couple months before it backs off. In Canada, famously, just last week it was reported in September that we had a highest inflation rate in 18 years at 4.4%. We're probably going higher in the next couple months just because of food and energy prices alone. And there's some other factors too that could temporarily push inflation as high as 5% for a little while. Now, we do think it comes down. Our official view is that inflation is going to average about 3.25% next year. That probably doesn't sound that scary, given we're at 4 and close to 5% now. To tell you that inflation is going to average about 3.25 probably doesn't sound that bad. But we haven't seen average inflation of 3% for a full year since 1991. That is a high reading on inflation. And by the way, that was the year the GST kicked in. So that's a relatively lofty reading for inflation. Canada is a little bit below the US. I've listed a few factors for why that is at the bottom: currency, cars, COVID. Very briefly, very briefly, the currency, of course, has strengthened a lot in the last year. That's actually helped to dampen, things like food and gasoline prices. It would have been even worse if the Canadian dollar had not strengthened. Cars, we've seen a lot of car price inflation here in Canada, but it's interesting, we actually don't include used car prices in our CPI. We never have. The US does. And used car prices have been on fire. So just from a technical standpoint, that's one of the reasons why US inflation is reading higher than in Canada. And the last one is COVID, and that just goes back to the fact that the US opened earlier than we did. So they saw a little bit more reopening pressure in things like airfares and hotels. Now, if we turn to the next chart, let's delve into what's really driving inflation in Canada. And this tells you what's gone up and what's actually still dropped in price over the last 12 months. And these are on the right-hand side. These are the fastest rising prices that we've seen in the last 12 months. Really, no major surprises there. A few of them are really obvious. Things like gasoline prices, of course, they were really low last year and they've now risen to record highs recently. So that's been the big driver. Natural gas, you can also see, is up there. I mentioned airfares and hotel charges. They haven't come back quite to the same extent as they have in the US, but they've come back. Of course, they were at the depths of despair last year, so they're coming off a very low base. But if we go further down that list, there's some things that I think have a little bit more sticking power, and I'm keeping a bit of a closer eye in terms of what could, lead to longer term challenges. New home prices have been strong. Meat and food prices in general are showing a lot of strength. Furniture and appliances, again, that's just a story of just a wave of demand overwhelming existing supplies. But those are strong gains for furniture and appliances. We're not used to seeing, 5, 6% gains for those sectors, and those are the kind of things I'm watching to see if inflation doesn't last a little bit longer than our forecast. I would highlight a few things on the left-hand side. There are still a lot of items that are actually seeing outright price declines. Telephone services are down. Sports equipment, that's partly because they were so high last year. Not everybody needs to own a Peloton. So we've actually seen sports equipment prices come down. Clothing prices, clothing sales have come back, but let's face it, a lot of us haven't been using our Sunday clothes in the last couple of years, and so there isn't quite as much demand for clothing. Some of these things will eventually turn around a little bit, but I think the key point is there are still some areas that are acting as a bit of a brake on inflation. One of the reasons why we don't think all of this inflation pressure will really persist much beyond this year. But I think the important point, and if we turn to the next chart, please. I think the important point is even when we get through some of the extreme near-term pressures, next chart, please, we still think inflation will be higher even by the end of 2022 than it was before the pandemic began. And it's interesting, the Canadian Federation of Independent Businesses surveys its members every month on all kinds of different issues, and they ask them, where do you see the biggest pressure points? What's restraining activity the most? And the latest survey actually just came out this morning, and unfortunately, I didn't have time to get into the chart because it was so very fresh, but it didn't really change the bigger picture. Basically, small businesses, what they're reporting is the real constraint on growth. It's almost textbook. It's exactly what you would expect. It's input shortages, labor shortages, and distribution constraints. Those are the things that are really deteriorated since before the pandemic. Whereas things like insufficient demand, it's actually seen as less of a problem than it was before the pandemic. Everything in blue is less of an issue than it was in pre-pandemic days. Everything in red is much more of an issue than it was before the pandemic. And like I said, it's almost everything that you read about in the papers or see online. It's all those kind of shortages of goods and labor that's really constraining business growth. Usually input shortages are a non-factor for businesses. For decades, they've been a non-factor. Well, now they're a real factor. And what's a result of that? Well, small businesses are expecting and medium-sized businesses are expecting that they have to raise their prices in the next year. And you can see that survey in the blue line fits very nicely with underlying reported inflation. And so small businesses have a really good pulse on where which way the wind is blowing and where the inflation pressures are going. And they're still saying that prices are going to have to rise in the next year. The average small business thinks that they're going to have to raise prices by almost 4% in the next year. And a lot of them think they're going to have to raise prices by more than 5%. And that near 4% outlook for small and medium-sized businesses actually fits our forecast for inflation pretty closely over the next year. The one thing we do think is that some of the most extremes in things like natural gas prices and oil prices will fade by the end of next year. We're not looking for a pullback, a big pullback in them. We just don't think that those kind of increases we've seen in the past year can really be sustained, and that's one of the reasons why we'd be a little bit lighter in terms of our inflation forecast than small businesses. Turning to the next chart, though, but there are a couple areas that I would like to highlight as still, you know, causing me a little bit of concern on the inflation front. Where can we see some real pressure that's sustained for more than just a year or so? Well, one of the obvious places is from wages. If wages really begin to kick in a meaningful way, well, then these price pressures could be a little bit more sustainable or last longer than what we and certainly other forecasters believe. And so I'm keeping a really close eye on what's going on in wages. I personally believe there's a bigger issue in the US than Canada at the moment. You know, as you can see from that former slide, a lot, and just a quick glance at the papers tells you there's a lot of sectors that are really, starving for workers right now, really having a hard time finding workers. Well, whatever challenges we're facing in Canada, multiply it by about 2 or 3 in the US. It is extreme in the US. In Canada, the number of job openings is still less than the number of unemployed. In the US, it's the exact opposite. There are more than 10 million reported job openings in the US. There's about 7 million people recorded as unemployed. That is just off the charts in terms of that ratio between the number of job openings versus the number of people actively looking for work and unemployed. In Canada, it's at the point where it's a bit concerning. It's likely to lead to some wage firming over the next year. In the US, it's just screaming that wages are going up from here. To this point, most of the pressure on wages has been at the low end of the income spectrum. It's been, it's all the anecdotal evidence, the Amazons of the world, the Walmarts, the McDonald's, they're raising their wages. It hasn't really started to filter further up the income scale yet, but we think it's coming. We think much more broad wage pressure, but especially at the lower income level, the lower wage level, is just staring us in the face in the US. And this is why, we think these inflation pressures have a little bit more staying power than others do. If we could turn to the next chart now, the other thing that I think is out there, looming out there, is just the strength in home prices we've seen in the last year on both sides of the border. Home prices in both Canada and the US are up about 20% in the past year. And every country handles home prices a little bit differently in terms of how it enters the consumer price basket. But the commonality is it takes time for a run up in home prices to really work its way into the CPI. That's especially the case in the US, but to some extent in Canada as well. So we think there's still a little bit more sting in the tail for inflation from the strength in home prices we've seen. Now, I do want to spend a minute talking about the housing market, because of course this has been one of the hot topics out there, definitely. You may have heard that, after the madness of earlier this year, home sales have moderated somewhat in recent months. But I would say the key word in that sentence is the word madness. What we were dealing with back in February and March was just unsustainable. It was madness. Yes, home sales have cooled since that point, but if you look at that chart on the left, where we are now is still stronger than anything we've seen in the pre-pandemic era. Sales are still very, very strong. The market is still extraordinarily tight. The pressure is it's still a seller's market nationally. Prices are still poised to rise further unless there are concrete steps, policy steps taken to cool the market. Now, if you look at the chart on the left-hand side, I call that my Canadian Football League chart. It's the 9 cities in the CFL. It's the change in home prices over the last 12 months. What you'll notice there is, first of all, every city in the CFL has seen home prices go up in the last year. But what you might notice is only one of those 9 cities is actually above the Canadian national average. Well, what does that tell us? Well, all the other cities, all the other smaller cities, are actually seeing price gains even above the national average. It's not the Torontos and Vancouvers that are leading the bus here. It's the London, Ontarios, it's the Chilliwack, BCs, it's the Halifax, it's the Quebec cities, it's the next tier down, it's the Windsor, Ontarios. Those are the cities that are really leading the charge, and it's for all the reasons you've read about. People, if they can work remotely, they can. If you don't have to, live in the big cities, you may have moved, you may have retired early. But for whatever reason, the real pressure has been in the more affordable cities. That's where we're seeing gains of 30 to 40%. Now, eventually, these kind of price gains will slow a bit, but we still remain constructive on the market unless and until interest rates begin to rise, we would still be constructive on the market. Now, there's some other policies that the Liberals proposed during the election campaign. We'll have to wait to see if they unfold. But I think ultimately what it's going to take to bring this market to heel will be higher interest rates. And that naturally leads me to my next slide, please. The topic that certainly is on the front pages today. We saw the Bank of Canada. I have to tell you, I was surprised. I was surprised at the tone from the Bank of Canada yesterday. They came out breathing fire. It was a very tough message. They basically ended their quantitative easing proposal. They flatly said, the risks are that they were going to start raising interest rates earlier than what they thought before. If anything, the governor, Mr. Macklem, doubled down on that discussion in his press conference. The financial markets that were already priced for a full percentage point increase in 2022 just jumped on that and brought it even further forward. The market is actually priced for a full rate increase as early as January. Now, I don't believe the bank is there, the Bank of Canada. I don't believe they're there yet, but clearly the risk is that the bank goes earlier than what we've been forecasting. Our official forecast is that the bank will start raising rates in July and start raising rates by or move at a quarter of a percentage point per calendar quarter. The risks are completely one-sided here, that they go earlier, that they go more often, and that they eventually lift rates further or higher than what we thought they were going to do. Now, I'm not talking about anything extreme. We think it's more or less a repeat of what we went through in 2017 and 2018. We may end up slightly higher. At this point, we think we just get back to where we were in 2018. But the risk is a little bit to the high side of that call. But I think, frankly, the big shift here is how quickly the Bank of Canada changed their language. It was only about 6 months ago that they were telling us, the earliest they could possibly be raising interest rates would be, late 2022, and that's the earliest we could. Now the discussion is, well, could they be going in January? There's a slight chance of that. I think it's very slight. The earliest I could see them going is in the April meeting. But, I think the main message here is, inflation has caught the Bank of Canada by surprise. Employment is back to a full, pre-pandemic levels faster than what they were expecting. And the housing market has just been much, much, much stronger than they expected. All those things point to the Bank of Canada moving earlier on interest rates than what even they expected as recently as just a few short weeks ago. And that's a fundamental change. The Federal Reserve in the US really hasn't tipped their hand yet. Keep in mind, the Bank of Canada just ended their quantitative easing policy. The Fed hasn't even started to taper. They haven't even started to wind it down. We think that begins next week, at next week's Fed announcement. So the Fed is definitely behind the Bank of Canada, but they will probably slowly but surely adjust their language in the next 6 months as well. At this point, we think the Fed does follow the bank. We've got the Federal Reserve starting to raise interest rates next September, almost a year from now. We too think that they will go by a quarter percentage point per calendar quarter. We think the Fed will be a little bit more deliberate than the Bank of Canada. The risk is, as I said, the bank goes a bit more quicker than our forecast. I have a hard time seeing the Fed going a whole lot faster than what we've got forecast here. Of course, when the Fed makes a decision, it affects all financial markets. Really, the Bank of Canada only affects Canadian financial markets. So there's quite a weight on the Fed. They cannot make a policy error. So we think they'll be a bit more deliberate than the Bank of Canada, but ultimately they'll get to the same place, if not even a little bit higher than the bank. For long-term interest rates in recent days, long-term interest rates have actually backed down a little bit, but ultimately we think they're edging higher. When we look out, we think that both short-term and long-term interest rates are headed to roughly the same place, and that's about where they were before the pandemic began. We think short-term interest rates will get up close to 2%. We think longer-term interest rates will get a little bit above that. The so-called yield curve will be quite flat when central banks are done. But we think ultimately that is the end point for interest rates when when the tightening schedule is done. If we could turn to the next chart, please, and I have to move along a little bit here just to make sure we have time for questions. I've talked a lot about monetary policy. I do want to spend just a minute on fiscal policy because I've had a lot of questions about the government deficits and debt in really since the pandemic began. We had a status quo election result on the political front, but just because it was status quo politically doesn't mean it was a status quo economically, because all policies or all parties talked about more generous spending policies during the election campaign. And, insofar as government revenues have actually been better than expected, we think that just gives more room or allows more room for Ottawa to spend more. And certainly they've been more than willing, and I think they're still lining up a lot of very generous programs in the next couple of years. So the kind of budget projection that you see on the left-hand chart, that's about a best case scenario. I think the true goal here is after we had this big step up in Ottawa's debt to GDP during the pandemic is basically just to maintain it at that higher level of about 50% of GDP. And that means the deficit is likely to stay relatively high, not the sort of $300 billion we saw last year, but I think on the order of about $50 billion in the years ahead is probably what we're looking at in terms of the budget deficit. My very last topic before I open it up to questions is on the Canadian dollar. If we could just turn to the next chart, please. Um, the Canadian dollar certainly benefited somewhat from the Bank of Canada's very strong message yesterday and the view that the Bank of Canada will raise interest rates before the Federal Reserve. But there's more going on here than just the Bank of Canada. The really strong comeback in commodity prices generally, the $80 oil prices, the $5 natural gas prices, the global recovery, all those things are positive for the Canadian dollar. We still think the cyclical backdrop favors the Canadian dollar. If you were to just look at oil prices, you'd think the Canadian dollar should actually be higher, a lot higher than where it is today. We don't think it's going up to 90 cents, but we do think that the Canadian dollar is likely to firm a bit further over the next 12 months. But longer term, I'm not especially bullish on the Canadian dollar. I think this country has a lot of very serious medium term challenges. I think we got a lot of competitiveness challenges. I view a fair value longer term for the currency to be somewhere in the 75 to 80 cents range. So if I were to extend that chart out further, to 23, 24, 25, we'd see the Canadian dollar drifting back down into the 75, 80 cent range. But as I said, I think the main message over the next year or so is the Canadian dollar is more likely to strengthen than weaken a bit further just because of the persistent strength in commodity prices and especially oil prices, and also because it does look like the Bank of Canada is poised to lead the way, at least in North America, in terms of interest rate increases. So that's it for the formal part of the presentation. I see I've gone a couple minutes over time, but I think it's left a lot of time for Q&A. So I'd now like to welcome Jamie back into the conversation to lead us on the Q&A. Thank you very much.
Awesome. Thank you, Doug, for the presentation. And I'm going to start off with some of the questions that we got in advance. And I see some coming in during the presentation as well around this topic of GDP and debt. The question that we got, what impact do you foresee on Canadians and its next generation on the ballooning national debt? How will it impact raising money for government and corporations in the international market?
And thank you for that question. If we stand back a little bit, it's important to point out that while it's unfortunate how much government finances deteriorated during the pandemic, if you look at the debt to GDP ratio, it's actually still below the bad old days of the mid 1990s, at least for the federal government. Of course, whenever you look at government finances in Canada, you really do have to bring the provinces into the conversation as well. Now, the federal government really carried the can in terms of shouldering most of the costs and burden of the pandemic, appropriately so, I will say. But provincial finances deteriorated as well, and in some provinces, we're actually looking at an all-time high in terms of the debt GDP ratio, including my province in Ontario. So when we combine the two, we there are many measures of government debt, and I don't want to overwhelm the conversation with tons of facts and figures. But when we look at a very broad measure of government debt, we are at a roughly speaking about 100% of GDP, and that's high. But certainly, the interest rate landscape is a world away from where we were in the bad old days in the mid 1990s. Adjusted for inflation, real interest rates are actually negative right now, or very low. So it does make that level of debt much more affordable. So if I were to address the next generation, I would say it's a concern, but I don't believe that it should be a handcuff on growth in the years ahead. I actually do think the level of government debt is still manageable, even if interest rates were to back up a little bit. I think it's manageable. The important point, though, is we don't have a lot of room for that debt to rise a lot further. So I would actually really encourage governments as we continue to recover in the next year is to get fiscal finances in, allow that improvement to flow through to the fiscal finances and get the fiscal finances in much stronger shape as the economy recovers. So, my word to the next generation is, it's unfortunate that finances deteriorated in the last year, but I don't think you should be overly discouraged. I don't think it's going to handcuff growth. It's not, you know, Canada, I always like to say we're the best looking horse in the glue factory when we compare ourselves to other economies. The joke there is we've all got a bit of a challenge on that front. But other economies actually face a much bigger, more difficult fiscal challenge than we do. The U.S. certainly does, Europe does, Japan does. So I wouldn't be discouraged on that front. It doesn't mean deficits don't matter, that we can completely have a free hand to run huge government deficits. But I wouldn't. To the next generation, I would say I wouldn't be concerned that it's going to constrain your opportunities.
Thanks for that insight, Doug. And maybe a follow-up question that's come in is, how will the government fund this deficit each year for the next few years, given the huge amount of debt in 2020 and 2021?
And, and by the way, I have to say that's probably been, when I think back to the last 18 months of the pandemic, that's probably been the number one concern I've heard from clients and customers over the years is, or over the last 2 years is, "Hey, how are we going to pay for this?" First of all, just in terms of borrowing, there is no shortage of appetite for Canadian government bonds. That's really not even an issue. The government of Canada can still borrow for 30 years at basically 2%, which is actually below inflation, or roughly in line with the Bank of Canada's target for inflation. That's still very generous. 10-year money is about 1.6%. Actually physically funding the deficit is not a challenge. How are we actually going to bring the deficit down in the next couple of years? Well, I would say economic recovery is the best cure for the government deficit, and we are seeing revenues coming back very nicely. Quietly, a lot of provinces have actually reported much better or smaller budget deficits than what they expected, even as recently as 6 months ago. So there actually has quietly been some good news, especially on the provincial front. Ontario missed their budget deficit forecast by a country mile, and I mean missed it in a good way. It was much, much smaller during the pandemic than what they had expected. And what's the story here? Revenues have really held up well, because of income and still pretty strong spending on goods. So revenues have been pretty good. I know there's a lot of discussion and concern that taxes are going to have to go up. I think that's a political issue. I don't think that's an economic issue. I don't think we need higher taxes. I think as the economy recovers, revenues would recover very nicely. And as some of these extreme programs and spendings roll off, the deficit will naturally come down in the years ahead. Tax increases now would really just be used to fund new programs. And so that's why I say it's a political issue. If the decision is we need a lot of new programs, such as things like universal daycare, um, then that's a political decision. And yeah, that does have to be funded somehow. That's a new program that does have to be funded. And so really it is a political decision. Do you cut spending somewhere else, or do you actually raise taxes, raise revenues? Um, I will say, I realize we don't have a ton of time, but I will speak very briefly in terms of what taxes might go up. I think you got to watch what's going on in Washington really closely. President Biden had this very aggressive spending agenda, the so-called social infrastructure, the Build Back Better plan. Well, that's been getting steadily scaled back. And why is it getting scaled back? Because some of the revenue measures that were supposed to go alongside of it, things like corporate tax increases and taxes on the rich, well, guess what? Moderate Democrats are not buying into that. So, at this point, it actually doesn't look like they're going to be able to raise corporate taxes. It doesn't look like they're even going to be able to raise the marginal income tax rate on the ultra rich. And ultra rich is a very different definition in the US than it is in Canada. In Canada, I swear people think ultra rich is anybody making six figures. In the US, it's people making seven figures. So we seem to have a different definition. But anyways, it doesn't look like taxes are going up in the US. Even though, there's a big wing of the Democrats who really want to see it go up, moderate Democrats don't want to see it go up. So Ottawa's not going to have the cover of higher U.S. taxes in which to fly under. So if they were to do something like raise corporate tax rates or raise tax rates on high income individuals, it would basically put Canada further out of line with the U.S. We already have a higher combined corporate tax rate in Canada than the U.S. We have a much, much higher high income marginal tax rate for individuals than we do in the U.S. So, they don't have a lot of room to maneuver on the tax front, frankly.
Yeah, thanks for that one. I'm gonna move over to talk about the dollar strength and currency. This question's from Cornwall, Ontario. If we're thinking post-COVID, whenever that might be, maybe next spring, what are the implications for the Canadian US dollars if the economy is exceptionally strong or exceptionally weak?
So generally, as a rule of thumb, and let's pretend for a while that Canada and the U.S. more or less grow roughly in sync over the next couple of years. There isn't a big divergence on that front. If you have an environment of strong growth and strong global growth, strong North American growth, that tends to be associated with a relatively strong Canadian dollar. Not always, but it tends to be because the flip side of that is when you've got strong global growth, a strong recovery, you've also got relatively robust commodity prices, which is directly a strong thing or a positive factor for the Canadian dollar. So I would say if we're looking at a relatively robust recovery, further recovery over the next 18 months, I would say that on the all else equal, that tends to favor the Canadian dollar. And frankly, that's one of the reasons why we are constructive on the Canadian dollar. Now, that rebound in the Canadian dollar alone will actually act as a bit of a dampener on Canadian growth, especially sectors that have to compete internationally, the manufacturing sector, the tourism sector, when we eventually do get back to something close to normal, it'll struggle a bit with a currency well above 80 cents. I personally think the Canadian economy can manage a currency in the 80 to 85 cent range. It's a bit hot for comfort, but I think it is still manageable for the economy as a whole. It's when we get back close to parity that you're really acting as a severe drag on the manufacturing sector, on the tourism sector. We saw that, in the last decade, that when we got and stuck around parity, it really did harm our manufacturing sector in a very significant way. We're not calling for parity, but that's the kind of level that I think actually really anything over 90 cents gets very uncomfortable for the manufacturing sector.
Thanks, Doug. While we're on the topic of currency, we have a question from Toronto. What's your opinion on the future of cryptocurrencies in Canada, the US, and the rest of the world?
So I'm not a fan of cryptocurrencies, but I have to say that it is a reality that I think is going to be with us for quite some time. I do not dare try to put a value on, say, what Bitcoin is worth. I do disagree with Mr. Buffett. Generally speaking, I have a ton of respect for Warren Buffett, and I agree with a lot of what he says. But he thinks there's no value whatsoever to Bitcoin. Others have voiced that view. I don't agree. Clearly, the the anonymous nature of being able to move money across borders, that is worth something to somebody. It may be nefarious people, it may be, money launderers and drug dealers and arms dealers who benefit from that, but clearly there is a value to Bitcoin. So I'm not in the league that says there's no value whatsoever. There is a legitimate value to Bitcoin and other cryptocurrencies as well, insofar as if they can reduce costs of moving money across borders for legitimate purposes. There is some value to Bitcoin. Clearly, to the younger generations, it has become something like, akin to digital gold. It is. I view it as an asset class. Um, uh, I'm personally not interested in it just because of the volatility. I don't know how to value it. I can see a case for it being worth $1,000. I can see a case for it being worth $100,000 or more. I'm personally not interested in it or investing in it. I think it will be with us for some time, though. I think cryptocurrencies do have legs. I think if we came back in 5 and 10 years, we'd still be talking about cryptocurrencies. What's interesting to me, though, is will central banks, and every central bank in the world is taking a long, hard look at this, creating their own digital currency. And I think probably some will. I think the Fed is certainly taking a long, hard look at it. And if we do get something like a Fed coin, that's going to be pretty serious competition for Bitcoin from a legitimate usage, because presumably you could use the Fed's digital currency to move assets across borders relatively costlessly or at low cost, anyways, without the volatility. Yeah, you won't be able to get 50% returns on it, but you also don't have to worry about it, dropping by 50% overnight on you. So I think for legitimate businesses and legitimate people, sort of central bank digital coins could really crowd out cryptocurrencies to some extent. But no, I think it's a very interesting development. Something that's now got a market value of about $2 trillion. We can't ignore it by any means. I think it's probably with us for a long time. One surprise to me is that most countries around the world haven't tried to step on it harder, haven't tried to regulate it more firmly, a la China. I'm a bit surprised. The U.S. hasn't been a bit more aggressive in terms of trying to regulate it, but it's grown to such an extent now that I think it'd be very tough to really put tough regulations on it. So that's one of the reasons why I believe we'll still be talking about, Bitcoin 5 to 10 years from now.
Awesome. Thanks for those insights. I'm going to move to the topic of housing and real estate. We've got a lot of questions on this topic. Um, Maybe a two-parter that will combine into one question. How do you feel about the housing rental business in general, and in particular, multifamily rental market?
So it's interesting, and this is one area of the market that's had a real, a real ride, real roller coaster ride. Of course, in the initial days of the pandemic, and actually it lasted for most of 2020, is we had this move out of the cities. We didn't have foreign students coming in. We didn't have, people couldn't Airbnb it, or in very limited cases. So demand for central core rental units plunged. At one point we actually had rents declining even in a place like Toronto. Who would have believed that? Before the pandemic began, we had some of the tightest rental markets we had seen, especially in places like Toronto and Montreal. And then it was like that it went exactly the other way. Well, now that market is starting to come back. People are starting to drift back into the downtown. Investment dollars are starting to move back into the condo sector. We're starting to see, lots more interest in condo. Condo prices have certainly firmed. It's actually been one of the stronger areas of the real estate market in recent months, making a nice comeback from last year. When we look at the whole course of the pandemic, there's no question it's been one of the weaker areas compared to, single family units out in the burbs or the exurbs, but it's coming back. The condo market is coming back. The rental market is coming back. We're definitely starting to see it firm up again. And looking ahead, when you look at some of the aggressive immigration numbers that the federal government has, even if we get a lot of supply, a lot of new, and there is a lot of new building going on, by the way, in the sector. I think the multifamily unit area is coming back. I would be relatively optimistic on that end. It looked like that was as I said, it looked like that was the part that was going to suffer during the pandemic. It did suffer briefly, but it's on the road to recovery, and I would be relatively upbeat on that sector. And partly because of just recall how tight things were before the pandemic, and with some of the very aggressive immigration numbers we have looking ahead, I'd be upbeat on that sector.
Wonderful. And to carry on with housing, you spoke about labor and input shortages earlier in your presentation. How do you see the impact across the construction industry impacting the economy and real estate markets over the coming years?
We've definitely got a shortage of all kinds of workers at this point. Almost every and it's interesting because as I said early on, the unemployment rate's actually higher than it was before the pandemic. I think with the ending of CERB Light, CRB, as of just actually this past weekend, and some of the tightening of some of the support measures, you might see the job market opening up a little bit more. Some people who might have been sitting on the sidelines might be coming back. It's still going to be a challenge, no question, especially in places like the restaurant industry. They're still going to be very challenged finding workers. I'd be a bit more optimistic on the construction side. I know, on the skills trade side, there are some serious shortages on that front. It seems like that's always an issue. It was certainly an issue before the pandemic. I don't know that labor is going to be the biggest constraint. Um, it's a challenge, no question. But of course, the industry does pay above average wages, and that's a big feather in its cap. The one thing I would say is that despite all those issues, the reality is the number of houses being built right now is some of the highest we've seen. So supplies are coming. In the last 12 months, Canadian housing starts have totaled 270,000 units. If we look back a couple years ago, housing starts are running at about 210, 220,000, which was pretty strong historically. 270,000 is actually one of the strongest numbers I've ever seen. The closest we've ever come to that kind of level of building, that pace of building, was back in the mid 70s. And at that point, we just had, the front edge of the baby boom was just moving in. Just there was an explosion in household formation at that point. So, home building is actually running at a very hot level right now. It's doing its best to keep up with the tidal wave of demand. The real pressure is just this relentless demand that we've seen, whether it's from the investor, from the millennial, people looking for a second place, new immigrants. It's just seemingly insatiable demand that we're seeing. I know most analysts out there say, "Oh, this is all a supply problem. All we got to do is fix supply." Supply is actually very strong. It can't keep up with that tidal wave of demand.
Yeah, thanks for those insights too. We'll pivot to questions on climate change. Got a couple of them here. It's a negative force. How do you feel that it's going to impact GDP? And do you feel that Canada would possibly be, subject to tariffs or duties for being a laggard on climate change?
So that first off is a huge topic. I'll try to cover very briefly. We don't have a whole lot of time, but that latter topic is definitely something to keep an eye on. There's a lot of talk about a border adjustment tax, and essentially and personally, I'd be all in favor of that. If Canada and the U.S. can align on that, basically it's a way to make sure that there aren't free riders out there who don't keep pace in terms of in terms of carbon taxes and trying to keep pace, and doing a real job. I would say realistically that kind of carbon border tax would be aimed at the likes of China. If China wasn't doing a serious effort to try to restrain carbon output. That's really who it would be aimed at. I'm not that worried about Canada being a laggard. We actually are. I believe the federal government is very serious in terms of what they're trying to do. And the reason why we're one of the biggest carbon emitters is, well, we're a cold, very spread out place that happens to be highly industrialized and is a big oil producer. There's really not much we can do about any of those things, and we're always going to be a relatively, compared to others at least, a relatively high carbon user. And presumably it will come down in the years ahead. The other question is very interesting too. Is does that adjustment mean we're looking at no growth or slower growth? It's that's an open question at this point. Certainly there's some sectors that actually can thrive in this world if we play this right. But yes, there are sectors that are likely to see very slow growth or even, declining growth in the years ahead. I suspect we're probably close to as high as we're going to get in terms of oil production in this country. That doesn't mean it's going to go into reverse quickly, but I think it'll face a long plateau and a slow work down in the years ahead. Canada, among the major industrialized economies, oil production is as important to Canada as anybody else, except for maybe Norway. And so, a threat to our oil sector is a threat to our economy. That is, at this point, we're hoping that other sectors can step up, can step into that void. But I think that when we look at the balance of risks, it probably does somewhat dim the medium-term growth outlook for Canada. So if we grew at an average pace of about 2% in the last decade, between demographics and the challenge of adjusting to a low carbon world, I'd say at best we're looking at 1.5% growth in the next 10 years, and maybe something closer to 1% growth.
Thank you. And unfortunately, we are at our allotted time now. So, Doug, I just want to say thank you so much for the fantastic session today. And for those watching and listening in, you've had the benefit of hearing both regional and global insights from Doug Porter, our BMO's chief economist. Doug, I always learn a lot from you. So thank you. And I hope everyone watching did too. We're so glad that you could join us today for this virtual conversation.
Thank you, Jamie.
Thanks, like Doug, they provide valuable insights, and we're definitely looking forward to hosting more of these. So ensure that you're getting the information and advice that you need. Please reach out to the BMO rep who invited you here today and send us your thoughts. Your feedback is really important to us so that we can continue to make the most out of these events. And I also invite you to visit BMO's Business Resource Hub on bmo.com. It's bmo.com/business resource hub. We are frequently updating, adding resources, articles, tools, calculators, and more to help keep your business running smoothly. So please check it out when you can. And finally, as we close out Small Business Month, we'd again like to recognize the incredible impact and contributions you're making to our economy and our community. So thank you for all you do. Thank you for joining us today, and I hope you have a great rest of the day. Thank you.